Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're starting off with a repeating guest for the podcast, Marvin Lowe. He's a senior global market strategist within the multi-asset research team at State Street Global Markets. You might remember Marvin from a couple of quarters ago when we've been talking about some of the risks that they're all seeing in this group. Now, his main responsibility is to leverage State Street's proprietary institutional behavior, risk, and inflation metrics to monitor market developments and also to come up with their impact on global currency and interest rate markets, all of which we're going to talk about today. He got his BA and MBA from NYU. Kayla Sater is a new person on CFA New York's podcast. She is a macro strategist within the multi-asset strategy team at State Street. She analyzes traditional macro factors with proprietary indicators with a focus on global, U.S., and European equity sectors. She has a BS from Northeastern University. So welcome back and welcome.
Thank you.
Thank you. Thanks for having us.
All right. So one of the things that I think is really interesting about the data that you all collect is it gives a good insight into a top level issue around how much liquidity there is in the market right now. So what are you all seeing?
Yeah, for sure. So liquidity is one of these interesting things that we all know it's important. We know that it's all around us. But in terms of actually seeing where that money is moving is something of an art. And, ultimately what we're seeing is that we're watching the Fed reduce its balance sheet. So, certainly the goal of tightening is to pull liquidity out of the system. But like many things since the pandemic, things are moving around differently. So the Fed's balance sheet broadly represents, at least on the liability side, either the amount of funds that the US government has or the amount of funds that we have from a checking account perspective, from a money market fund perspective. And we've got these categories which we haven't seen before. So we spoke about it actually, I think, in some of our prior podcasts. The reverse repo facility is this new facility that's out there. And when we kind of look at the overall liquidity within the Fed's part of the market, if you will, there's about 3.2 trillion in bank reserves. There's about 1 trillion in reverse repo at this point. And I think the Fed's goal is to try to get that number somewhere to around 2.5 to 2.8 trillion or so. During this journey of QT, they've shrunk the balance sheet about $1 trillion, but only about 150 billion has come out of the banking system. And that's where the transmission mechanism is different at this point. So in certain aspects, we could say liquidity is getting tight. Certainly the bank failures earlier this year showed that there was tighter liquidity. We're seeing treasury liquidity get a little bit tighter, particularly around this volatility. But overall, there's still a lot of liquidity in the system, and it's making its way into the banking system either through deposits, non-traditional deposits, and or really supporting lending, which is why I think that the Fed continues to need to reduce overall liquidity, because when you look at the balance sheet, it's still just too big.
Right. Now, the Fed's reduction of the balance sheet at the rate it's going right now will take a while.
Yes.
Right.
Yes.
Is that by design, or are they just being exceptionally cautious at the beginning?
You know what? I think they're being exceptionally cautious. The first time they started to do QT, and remember, this is only the second time they did it. The first time it was a horrible fail. My daughter would say that was just a terrible fail on their part, and they ended it much earlier than they thought they were going to need to. So they are moving gingerly, even though in my mind they should probably be more aggressive about it just because the balance sheet got so big. But if we kind of use these numbers that some of the Fed officials are talking about, another 2.5 trillion, if you will, which is what Governor Waller put on the table a few weeks ago, it gets us into mid-2025, maybe the end of 2025 before we kind of hit that target. I'm not sure they're going to get there, but they want to take their time and they want this thing to go on for a while in my mind.
Right. And naturally, one of the other things that sort of makes that all okay is growth. Right. So what type of risk do you think that presents to the Fed's overall reduction policy?
Yeah, I mean, for certain, one of the policies that most of the central banks have pursued, really since the GFC, is to grow out of their problems.
Right.
Let's see. Let's just let GDP kind of take care of our problems. It's hard to say that we're going to really have a significant slowdown in growth when we're looking at kind of these third, fourth quarter GDP expectations, which are well above trend. So, maybe there would be some benefit from a GDP perspective. But remember, it's a double-edged sword, because what they're really looking to ultimately accomplish is to reduce inflation. And if we're talking about the ability to grow out of this because growth becomes, let's say above average. Right now they have trend growth at about 1.8 to 2%. That still gets us to a 2025, mid 2025 to end of 2025 number with regard to the reduction of the balance sheet.
Okay.
If GDP is higher and it makes that number, let's say, a little bit closer to now, I venture to think that means inflation's not going to get under control, however. So it's a real tight walk in terms of what they're trying to do here.
Yeah, it's like the least favorite job that people have right now is working there, because the balancing act is like something
Yeah,
else.
yeah, and the number of balls that are up in the air certainly feels like there's someone on the side just throwing more and more balls for them to try to juggle.
Yeah, and maybe some of those people are the rating agencies who came out and said, "Hey, this
Yeah,
might
you
be
know
the end
what?
of the music here." So,
Yeah, I have issues, and we're digressing a little bit here. I have issues with the concept that the U.S. can't pay its debt.
mhm.
We could ultimately, and this is my soapbox, right? We could always, for better or for worse, print more money to pay those bonds off.
Mhm.
Certainly, there are questions about where dollar homogeny will go decades from now.
Right.
But it's firm right now. The U.S. is going to pay its debt. So to me, it seems a little bit silly. What they do correctly, however, is to talk about just how unsustainable these deficits are, and what the plan is around that. So that's a valid discussion. But does that mean the U.S. has less of an ability to pay its debt? I don't think so.
Right. I mean, it's. I guess one of the things that you mentioned earlier, and I used to work at one of the bond rating agencies, so I'm well aware of this dollar homogeneity thing, was coin, and that came on fast and left real fast.
Right.
So,
Right.
and
Exactly.
a lot of the coins that came out were linked to the dollar. So I was like, okay, I'm not sure what the purpose of that is, but okay.
Exactly.
So,
Exactly.
so yeah. So I mean, I think this is, also you feel free to put your soapbox back out anytime you like, by the way. This is, this brings down to a very difficult thing, but a very important one. A couple things are a little confounding to me. Growth is still going along as we just said. The housing market seems to be going along just fine too. In some places, even kind of hot. The overall economy seems to be sort of warm. How is that happening with rates like this?
Yeah. So it really is showing how challenged the transmission mechanism around monetary policies in the US
Yep.
relative to what we're seeing in the rest of the country. So we had so much stimulus over the course of this 2020, 2021 period that it supported a lot from a financial markets perspective, and it supported a lot from a spending perspective. We do see that the divergence amongst different groups are really being felt, however. So as we kind of spend down those excess savings, I know that there are, the bottom half of the income strata is suffering.
Right.
If there's wealth left, it's in the top 10, top 20%.
Uh-huh.
But the fact that we've got job creation still, there might be structural issues with those job creation. So we'll just have to see if, in fact, we've got much less people for what winds up being as many jobs as before. It's something that we at State Street Global Markets have spent a lot of time on in terms of structural changes in the employment market. That continues to put income into the economy. And then I get back to the amount of liquidity. And I think that part of the discussion that you want to go down eventually is around the banking system.
Yep.
And we're still getting support for making credit card loans within the banking system. So that makes its way into the economy.
Yeah, I mean, that was a really interesting chart in your report. I'll just give a little, promotional for
Thank you.
the banking sector update, the News Titans, which is which is a great title, but it does show a little bit about what I was saying. Is that in this report, to summarize, you all say that basically the bank failures of earlier this year were basically idiosyncratic, right? Although they were maybe sort of a canary in the coal mine, and the bigger stuff is coming. So yeah, so have at it. What do you all think is particularly interesting in this report, and and why should people read it?
Oh yeah, I think there's a lot to dissect there, and I think part of what makes it so interesting is that because it really highlights the challenges with the transmission of monetary policy. And what's really interesting, or one of the things that's very interesting, is that we're kind of in this really exceptional, uncharted territory. We're starting to see declining M2 or money supply year over year for the first time since World War II.
Right.
And
Ever almost. Yeah.
yes, yeah, that's exceptional. Although we are seeing contraction in commercial bank credit, it's really important to see where we're seeing contraction and where we're still seeing expansion.
Mm-hmm.
And so when you look at actual lending and what's going on and what's going into the economy, yes, there's a rather a decrease in lending in terms of C&I, for example.
Right.
But on the consumer side, banks are still happy to lend, particularly in terms of credit cards and things like that. And so that's really stimulative, particularly until we start to see, I think, challenges in the labor market. And one thing that's not in this piece, but it's actually, I think, pretty important, is when you look at concerns amongst different kinds of companies, they're mostly still concerned with A, inflation, and B, employment.
Mm-hmm.
They're not concerned about funding stressors or things like that, which is really remarkable given where rates are.
Yeah.
And so I think until they start to feel the pain from that, they're not going to, their priorities aren't going to shift. And so tying that back to the consumer, it still makes them willing and able to access credit card debt and things like that, which ends up being stimulative. And if they're still able to have job security, and they're still, I would say, comfortable with their 30-year fixed rate mortgages,
right,
banks are probably still able in the short term to lend. And so I think that's probably why, to answer your question from earlier, why are we still seeing growth despite 500 plus basis points of hikes? I think that's some of the rationale why.
Yeah, I mean, this is very interesting. I'm sure I'm not the only person who has gotten invitations from my bank to refinance my 3.75% mortgage. I'm like, yeah, great. No, thank you. I think we'll just pay it down. Thanks, guys.
Yeah. You ripped that one pretty quickly and just throw it in that circular filer, right?
Just to go back to something you just said, Kelley, I think this report is extremely interesting because I haven't seen so many different permutations of the subsectors of the banking industry and also the banks by size.
Yes.
You see a lot of reports that say, banks overall, and we're talking mostly about the GSIBs here, are doing this with C&I or this with commercial real estate, but you don't see it across large and small banks. And I thought this is an exceptionally interesting part of this report, that small bank CRE is going actually pretty strong and kind of consistent over years. Whereas the GSIBs aren't going to touch that because of the various complications that it creates with their regulatory environment. So, that this is something just to sort of, talk about some things I thought were interesting in your report. I also haven't seen too many distinctions between the large and the small loans, which is also in your report, which I think is also really interesting across many different banks. So, I do think this is interesting. By the way, how can people who are listening to this podcast get this?
So a lot of this data around breaking it out in terms of size of banks, that's actually from Fed H8 data.
Okay.
So that part is not proprietary. So you can definitely find that in the Fed.
Okay.
And then if you want to see the report, actually, contact someone at State Street Global Markets, myself and or Kayla.
Yep.
Certainly happy to share our analysis with folks if they want to kind of see kind of the thought process that we use to come to the conclusion that we need to see a lot of this liquidity continue to drain from the system so that Fed rate hikes have a bigger impact on the economy. And again, it's cited fairly often at this point. After 500 basis points, we're going to get, and we're recording this right before the third quarter GDP number.
Right.
We're going to get a 4 to 5% GDP number.
Right.
How does that make sense? Well, it makes sense if you look at the amount of liquidity that's still sloshing around the system in a very credit-driven economy.
Right. And I think, most people who have been trained as CFAs know that doesn't last forever.
For sure.
That's the problem with that. I would like to also talk a little bit with you all about currencies because tightening credit around the world has had a differing impact on a lot of different currencies, even in the developed world. So Tell me what you all are seeing there. I mean, that can create a lot of issues for people who have even 14 to 20% of their portfolios allocated to non-U.S., which is the kind of average for asset owners right at the moment. So, and most of them are a little bit below their return expectations for emerging markets investments for the last 2 years.
Yeah. So, we're seeing, and from a price action perspective, dollar strength has come back to the forefront.
Mm-hmm.
It had been one of the stronger trades last year. And then when we were getting, in our minds near the end of the Fed's tightening cycle, you saw some dollar weakness. People tried to take profit on that. They tried to look for opportunities, particularly around the carry trade going to the emerging market.
Yep.
More recently, with, once again, the spike in yields and the U.S. exceptionalism that's kind of driving a lot of that discussion at a time when you're really seeing the tightening that the other central banks, particularly in the G10,
yep.
Having a bigger impact on their economies, particularly in Europe. Dollar strength is kind of coming back into one of the more popular trades. So our investor behavior data, which is based on real money, does show that there's still a lot of dollar buying, even though overall positioning is overweight, because it's one of the themes that they could still hold on to. The Fed, whether or not they hike another time before the end of this year, they're probably not cutting in our minds for an extended period of time.
Right.
Whereas when you look at the economies in Europe, they're probably, we could try to guess who's going to be the first to cut. The other trends that we're seeing within our investor behavior from a currency perspective is, again, the themes that you can grab hold of, because there's so many cross currents out there. But commodity currencies, particularly those that have oil exposure,
yep.
are starting to make sense. Real money is buying into those currencies, and they are selling fairly aggressively on the European side of things, just because of that growth concern. And the last thing I would say is that the rise in U.S. yields over the course of the last 6 weeks to 2 months has been more real yield driven, more term premium driven. That creates probably more risk for that creates more concerns for risk assets.
Okay.
And certainly more concerns for the emerging markets, which do not perform that well.
Right.
So we are seeing those popular EM trades, which existed the better part of the summer, going to early fall, get unwound at this point, where EM is nowhere near as attractive, given all of the uncertainty that the changes in the U.S. curve are having on the potential attraction of some of these other, particularly emerging markets, as well as emerging market currencies.
Yeah, I guess one of the things that is an interesting mitigant to that, and we've seen this probably reshape some of the foreign policy of Venezuela in the last couple of weeks, is the export of energy, and probably for places like Peru, the export of minerals, also, which particularly the rare earth minerals that are important in battery production.
Yeah, certainly, if we are in a higher for longer and potentially a stickier inflation environment, which is, really one of the things that's driving kind of this increase in real yields as we try to figure out how the world settles after the pandemic, if you will. There are going to be winners and losers from that perspective also. We do like oil-driven commodities, oil-driven type equity discussions, and certainly Kayla could speak to that better than I can. Global growth issues do not make other commodities as attractive, however. So this is the time to really sort through your themes and the thesis that you're driving into it to figure out how you think the winners and losers are going to evolve.
So yeah, Kayla, please have at it.
Yeah, I think kind of on the equity side of things, and just to be a bit more specific within the commodity space, definitely like energy. You definitely do not like materials, though.
Okay.
And so part of the rationale with that on the energy side is supply, and just all of the dynamics that continue to be supportive for oil supply, despite some concerns rather around whether or not demand will increase, decrease, most likely decrease, but things around replenishing the SPR and what that means for actually taking supply out of the overall oil market, how OPEC has proven again and again that they're more than willing to really control supply in a way that's beneficial for them.
Like anything else can happen, they still do it. It's amazing.
Yes. And then the other point too is just energy companies We're very conservative in terms of CapEx spending and things like that, very disciplined, unlike what we saw, a decade plus ago. And so they really have strong fundamentals. Some of what we're seeing in terms of investor behavior on the energy side is positioning last year was very overweight in energy. It came down a bit, and where it is now, it's overweight, but not egregiously so.
Okay.
So there's still room to add within the real money community to add to those positions. And so this is something that we definitely have written quite extensively on. And so I would definitely encourage folks to reach out to us because we have quite a few reports on that.
So I guess one of the other questions that sort of makes me zero in on a little bit is Europe, which had a significant policy response last year to energy prices. And that had a major impact on some of their ability to do some other things. It's getting cold in most all but two of the OECD nations
Right.
in the next couple of weeks. So what do you all have in your forecast for Europe for this coming year?
So in terms of whether or not we go through an energy crisis the way we did last winter, natural gas is a big part of that discussion.
Right.
So the way real estate is always local, a lot of these energy markets are always local also. And, the difference between Brent and WTI and kind of the prices that they reflect what those local markets might be doing from a supply and demand perspective. But certainly gas is a big part of the European discussion. They are pretty full on their gas going into this year. So we should not see the same degree of energy concern going into this winter versus what we saw last winter. And having said that, one of the questions that people have is, is this energy volatility something that's going to be with us to a degree that we didn't have before the pandemic? And if that's the case, certainly Europe does not have the degree of energy independence the way we do. And those energy prices translate more directly into the inflation discussion. So as we see these economies really slow down fairly aggressively in an environment where you could get a spike in energy prices, it has a bigger pass through into that inflation discussion to a degree that we don't see in the U.S. So ultimately, it does once again put many of these European economies on a back foot, and again, applying it from a currency perspective. We've seen more interest in the dollar for a number of reasons, but that certainly is one of them also.
I guess one of the things that has been exceptionally interesting to me is, say what you will about the speed of the decision making by the EU, but boy, they built natural gas infrastructure real fast.
They did.
It's pretty impressive. I guess one of the things that you point out there, and this is sort of the part of the reason that feeds into some of these things, is just the slowing growth in Europe is going to be real hard to change with the policy levers they have.
Yeah, for sure. And the Eurozone experiment, the Euro experiment, had a lot of tarnishes before we went to the pandemic. They didn't go away, so it was easy to have this holding hands moment, if you will, across the EU when they were all fighting inflation.
Right.
And they could unify behind the fact that prices were too aggressive across the Eurozone. Now that we're starting to see winners and losers, and we're starting to see different amounts or different thoughts around how much stimulus to put into their economies, I think those blemishes will once again rise to the surface, and we'll just see how well they can manage those strains.
Yep, it's going to be an interesting winter. I think the other thing that's going to change the game a little bit is the EU is about to get a lot bigger, and that's going to require some changes to their policies. Maybe having just one to veto might not be the best idea when you have 50% increase in the number of member states.
Yes, which with ultimately very different economic profiles too.
Yeah, very. So, all right, great. So, this has been exceptionally interesting. Thank you both for being here, and thank you all for listening into this podcast. Now, if you're keenly interested in the energy markets, we are going to have a December event that's going to be on the energy markets. At the moment, we have a couple interesting speakers, including some Canadians coming on. And boy, nobody knows energy better than they do. So please stay tuned for that, and thank you all for being here. I'm Rob Rowan, and this has been Compound Insights.